are Moody's chief economist, Mark Zandi, and Joe Livornia. He is SMBC Nikko Securities chief economist and a former economic advisor during President Trump's first administration. It's great to have you both here. Mark, I'm going to start with you and get your reaction to Barkin, who is not a voting member of the FOMC, but certainly echoes what we've heard from a number of Fed officials since that FOMC decision earlier this month.
Well, I think tariffs put the Fed in a tough spot, right? I mean, they raise prices, inflation, so that would argue for higher rates, but it also weakens growth, which would argue for lower rates. So what do you do? They don't know. They don't know how this is all going to play out given the uncertainty involved. And so they're just sitting on their hands, and they're not going to change policy. So, there isn't much economic policy out there that makes life more difficult for the Fed than tariffs. It's a shock that just very difficult for them to figure out what to do with it.
Joe, there's a lot of talk eking into the market and in the economics community, investor community, about the rising risk of stagflation. Is it warranted, or are folks missing some of the nuance around tariff policies?
I'd say they're missing the nuance around tariff policy because it's part of a more holistic program whereby if you have tariffs, and the tariffs are used for a variety of reasons. I understand many of the points that Mark will probably disagree with me on, but the tariffs are going to raise revenues and ideally encourage capital back into the U.S. But that only works if you've got low corporate tax rates, a very friendly business environment. We change the permitting process. And then, of course, you have low energy costs so that when you make things, the after-tax return and the input costs on those are low. So to me, the tariffs need to be looked at more organically, more holistically. They're neither good nor bad. Tariffs in economics, there's the removal of consumer surplus, removal of producer surplus. So there's some dead weight loss, as economists say. But there is also revenues to the government, and it's a tax. And we need to look at, I think, less hyperbolically and look at how it's being used as a tool. And we could debate about that, but I don't think tariffs are inherently bad. In this case, I think they could be quite good.
But, Mark, we don't know, do we? I mean, I'm trying to think, well, this is kind of an experiment. Pro-tariff economy watchers seem to be assuming that the U.S. market is so big and so essential that imports are going to continue at roughly the same pace as they have been. Demand won't be affected. Do you think that's likely?
No, and I don't think there's much debate. I mean, I think most economists would, based on history, and we've got a lot of history here, I mean, decades, centuries worth of history, that tariffs are a pretty bad idea. They're a tax, as Joe mentioned, on consumers, and it's a very regressive tax. It hits low, middle-income households harder because they devote a higher share of their budget to imported good. It's a tax on American business. I mean, many businesses use imported product in the things that they produce, and of course, it invites retaliation. That always is the case. Other countries aren't going to stand still, particularly if they think that the tariffs are going to remain in place for a long time. If they're actually going to be used for generate revenue, I think other countries will respond, and that costs American jobs. And that's just the near-term impacts. I mean, longer run, it reduces competition, and it results in less investment and lower productivity growth and higher inflation. So I don't know. You add it all up, I think history is pretty clear here. Even the history that came out of President Trump's first term and the tariffs that were imposed then, which are very small in scale to what we're talking about here, the strong evidence is that they didn't work out at all well for anybody. So it's a lose-lose.
Okay. Joe, thinking back to what Barkin was just saying.
I just want to address the history aspect of it.
Address it, but first let me form my question. Joe, is it your position that Joe, let me form my question and then answer however you want. We don't have a lot of time. Is it your position that these tariffs will not lead to a significant recession, or that if they do, it's not a big deal?
You already knew the answer. No, see, that's not the right question. If we're talking about history, and I understand Mark's points. We talk about history. You go back 100-plus years. In Smoot-Hawley, the U.S. was the world's largest producer. We had a lot of production relative to consumption. That's the exact opposite today. We've got too much consumption relative to too little production. So we need to realign the system. The Great Depression was not due to Smoot-Hawley and tariffs. It was done to the Federal Reserve that was aggressively tightening policy and let the banks fail. Inflation today, it's a price level adjustment. We know from the last period that the price level was absorbed through margins and the currency. We'll see what happens this time. We don't know. We're still in the negotiating phase. So let's not just assume that everybody knows the answer. You're making as if there's more agreement on this subject than it is, and that's the issue that I have.
So my question, are you saying no recession, or if there is, it's not a big deal?
We didn't talk about recession. Right now, if you look at the data in the first quarter, real income is up 3.5%. I do not expect there to be a recession.
Okay.
No, I do not expect there to be a recession.
Then we'll see.